So South Africa is out of a recession. That's the big economic story this afternoon. Stats SA telling us that the economy actually growing by 2.2% in the third quarter. That's from July to September. Let's take a look at what the year looked so far as GDP growth is concerned. You'll remember that in quarter one, January and March, we had this staggering contraction of the economy, minus 2.6%. Weighed heavily by agriculture and manufacturing and mining to some extent. And then the contraction not too bad between the period of April and June. Nevertheless, the economy is still contracting, minus 0.4%. That officially put us in a technical recession. Not great news for jobs, not great news as far as ratings agencies are concerned and our credit worthiness. And then today's Stats SA telling us that in quarter three, the economy actually expanded by 2.2%. What were the main drivers? Well, chief among those big drivers was agriculture, 6.5%, mining, a growth of 7.5% as far as output is concerned. And there's the big negative number. Mining, negative 8.8%, still dragged down by policy uncertainty. And basically, it's very costly to mine in this country, and then trade 3.2%. Just very quickly, what do these numbers mean for average South Africans? Well, if you look at our population, 1.5%, that's the population growth for South Africa, and you just transfer that to the GDP growth, at least what is expected for this country as far as Treasury is concerned for 2018, we're sitting at 0.7%. If those numbers aren't aligned, it simply means that South Africans are getting poorer and jobs may be more difficult to come by. Well, Citadel Chief Economist Maarten Ackerman joins us now for a closer look at these figures. Maarten, good afternoon. I mean, I suppose the first question is this really technical, or are we seeing an improvement in the economy as reflected by this last figure?
It's definitely an improvement. So I think at this point in time, we had a very difficult year. So any of these numbers are very positive. The fact that it's also in manufacturing and agriculture, because that's really where we need to create jobs. And the only way you're going to do that is by growing those industries. But the last slide you showed there, that's still my concern, that, yeah, technically we're out of the recession, because, we've got a positive quarter. But in reality, since about 2013, we struggled to get more than 2% growth per annum out of this economy. And if you can't grow faster than the population, then you're actually in a recession because people are just getting poorer. So until we get to that number, I think the tough times are still ahead. So the 2.2 will definitely take, but if you then take into account quite a negative first quarter, revised a little bit better in the second quarter, but then the last quarter of this year is probably need to be very strong for us to get to the 0.7, 0.8 that most people are forecasting for 2018. So a positive number, but still a lot of hard work ahead of us.
We try and look for evidence as to whether or not the investment drives, the attempts to boost this economy with incentives, with stimulus are really working. So let's focus on those agricultural and manufacturing sectors. I mean, a sizable contribution this time around. Again, I bring that question. Is it just sort of base effects on numbers, or are we seeing perhaps a return to some sort of confidence and maybe a wish for jobs to be created there?
Well, I think if they can continue growing at those kind of rates, obviously it will start to create jobs. I think it's quite early to say that this is a result of new policy and especially a call for fixed investment. We've seen a lot of commitments after the investment summit. That money is only committed at this point in time and is only likely to flow probably after the election next year. So that means that a lot of the numbers that we are seeing now is a combination of base effect, especially if you think about something like agriculture, even manufacturing. And the evidence is, if you look at the gross fixed capital formation number, was down another 5.1%. And in fact, we haven't seen a positive for a number of quarters. And this number is again weaker than last quarter.
And that's important because that number tells you whether or not investors are throwing money at this economy.
So it seems like from that point of view, you could probably add to that construction, which was the second weakest sector next to mining. Those two numbers are saying to us that fixed investment or in new investment is still not online and coming into the economy. And that is something that we will need to, first of all, increase growth further, but also to get growth to be sustainably above 2.5% to 3%. So that shows you that this number is a good number, but it's still risk to the downside because we haven't seen the structural changes taking place. Only once we see that, then you can bank on a 2.5% growth number, and then you will start to really create more jobs going forward.
You speak about fixed investment, and I want to know if I'm sort of clutching at straws here to tie this to the mining output number, minus 8.8%. And one wonders, is this really the fact that it's just too costly to mine in this country, given the labor costs and the input costs? And is policy uncertainty a big component to that minus 8.8%? I ask because had that number been positive, we probably would have seen a very nice overall GDP number for the third quarter.
I think mining in South Africa is, like you said, there's a lot of headwinds. So the industry is a fading industry, unfortunately. So it's getting smaller relative to the rest of the economy. It doesn't need to be that way. I think there's still a lot of profitable mining opportunities, but the only way we're going to get fixed investment into that space is by having more clarity on the industry going forward. That's the one thing. The other thing is we must also remember that it's been quite a soft quarter globally. So in terms of commodity demand, despite the fact that the currency over that quarter was actually should have been more in a position to make us a little bit more competitive. So we're seeing a soft patch globally that's putting a dampening effect on commodities, obviously. And then if you add all the South African specific mining sector headwinds, that all contributed to that number. And then the point you've made about the quality of our grade that's coming out, the cost of mining, we've got very deep, very old mines, and then you add to that labor unrest and uncertainty. At the moment, unfortunately, it's not an industry that's looking very attractive from an investment point of view, and that's why the policy that's on the table needs to be implemented to actually attract more investments into that space. It's a very important sector from a tax point of view, so the sector specifically contributes more to the tax revenue than what it might contribute to the actual economy.
We're going to have to leave it there. Chief Economist at Citadel, Maarten Ackerman. Thanks very much indeed for coming in. Well, let's just turn our attention to the local market to see if that GDP figure